This is LBC, leading Britain's conversation with Clive Bull.
Evening, if you've just tuned in. Coming up in this hour, what are the prospects for future generations of older people? Will the state pension be enough to live on? Will the retirement age continue to increase? And should young people be planning now for what life will be like when they're old enough to be a pensioner? I'll be joined in this hour by Charlie Redding, author of Dream Retirement. He's also one of the country's top financial advisors. Charlie can explain the financial opportunities that exist and the mistakes people make. We'll talk about the Chancellor's pension reforms. And if you'd like to make a point or ask a question about retiring or taking out a pension, call us now, 0345 6060 973. That's the number at LBC. 0345 6060 973 is the number, and we're talking about do you ever think about what's going to happen when you're older? Maybe you're coming up to pension age. Have you made plans? Do you know what to do with what you have? Should you take out a pension at a younger age? Whatever your question about retirement and pensions, call now 0345 6060 973. Let's say good evening to Charlie Redding, author of Dream Retirement, which is just coming out, and a financial advisor. Good evening, Charlie.
Good evening, Clive. Thank you for inviting me on.
Lots to talk about in the pension world. It's funny that it used to be quite a dry subject. It's actually a bit rock and roll now, isn't it?
It's probably the first time in my career so far that pensions could be described as a very hot topic and almost possibly even cool.
Yes.
It's it really is a topic for conversation at the moment.
And there are big changes going on. Let's talk about a few of those. And I read something in the paper today about a kind of a top-up system to do with a state pension, which is a fairly unique idea, apparently. It gives you the chance to top up your pension. Is that right? Is that how it's going to work?
That is right. It's basically what they've said is along with the changes that are being made to the basic state pension, one of the ways that you can catch up if you're not going to be entitled to the full basic state pension is by either making a lump sum contribution, which has certain merits, or indeed actually there's an alternative way of deferring the state pension for a couple of years. So yes, you can boost your state pension by a couple of different mechanisms.
Oh, okay. And the state pension itself is going to change, isn't it?
It is.
To a flat rate, but not everyone's going to get the same.
That's exactly it. It's a flat rate.
That isn't flat.
That isn't quite flat, and it is not quite as flat as everybody originally thought. Essentially, the government are making good strides towards kind of simplifying the whole thing. They're getting rid of the earnings-related side of the pension. They've got rid of the means-tested side of the pension, which actually discouraged people from some of the lower-earner people saving for their retirement. So they've just tried to bring in one flat state pension. That means that every bit of saving that you do for yourself is only going to further enhance the income or the money that you've got in retirement. So that's definitely a good thing. You do need to have done 35 years of paying national insurance contributions to qualify for that full state pension. And if you've been contracted out of the state pension, when you've been contracted out of SERPs or what later got called S2P, then you might not be entitled to as much as you originally thought. But yes, in theory, the changes are positive, I think. And
the other big change, which if you want to ask about, you're welcome to call in as well, is grabbing some of your pension money up front, which you didn't used to be able to do, but George Osborne, we seem to have spent the whole evening talking about George Osborne's announcements, actually, but this was another one he made in the budget, and there were figures just out saying that so far billions, I think it was 25 billion have been taken out of pension pots now. So is that people buying yachts and Ferraris, or are they being sensible?
Well, firstly, yeah, I mean, there's been two huge changes to pensions in the last 12 months. The one that's got most of the press is the ability to take more of the money, in fact, all of the money out of your pension if you want to. for me, that's actually the slightly lesser change, but we'll address that one first. People have been disillusioned with pensions, quite a lot over the years, and so this has given people the freedom to be able to say that they can just take the whole lot out and they can effectively do whatever they want with it. And yes, in theory, they can go and buy the proverbial Lamborghini as been thrown around. I think a lot of the money that's been taken out has been smaller pots of money that people sort of didn't want to buy an income with, and pots of money that have been left there because they didn't really need the income at that moment in time. There are also some very wealthy people that have taken huge chunks of money out because they are worried that the legislation might change in the future. But ironically, the changes that have happened, actually, the other change will encourage more people to leave more money in their pension for longer. So whilst the bit that gets the most press is the fact that you can take all this money out of the pension if you want to, the scrapping of the 55% death tax on pensions actually means that leaving the money in the pension is even more sensible than it was previously. So I think that's the change that hasn't got as much media as it could have done.
0345 6060 973 if you'd like to join the conversation. Charlie Redding is author of Dream Retirement, an expert on this whole area. If you've got a question, you'd like some advice or you'd like to make a point, then call now. You can also text 84850. You can email clive@lbc.co.uk, and you can tweet at LBC and at Clive Bull. Let's go to Steve in Uxbridge. Hello, Steve.
Hi, Steve.
Hello. Hi, guys.
Hi, what can we do for you?
I nearly forgot the question because I was on the phone listening. All right, the question is, well, it's two actually. One of them is, what if, just say, you're part-time or you start work late, etc., and you don't get to the pension? That's one question. And the other one is, if you do get to the pension and it's the minimum pension and you've only got that income, and what if you can't live on that income?
I think there's two really good questions. Yes.
Well, they're very challenging questions, but thank you, Steve. I mean, effectively, if you've only accumulated a small pension pot, one of the options that I did mention earlier that might be a useful thing to consider is to defer that pension and try and carry on working for that a little bit longer. The reason for that is those deferrals of the pension will boost the amount of income that you then get at a later stage, and that deferring of the pension is actually quite a lucrative way of making that. It's boosting that pension some more. The deferrals are much better value at this moment in time than if you were to go off and buy an annuity yourself.
Right.
So deferring that state pension, if you can possibly do that and get some, continue to work for longer than maybe you'd anticipated, would probably be the better way of doing it. Of course.
Sorry to interrupt, but you mentioned the 35 years. Is that you've got to have basically paid in for 35 years to get your full pension? That's
correct.
And that's what you're referring to, is it, Steve? That you're worried you might not have done the 35 years?
Well, I haven't. One of the questions was for me, because I've done a bit of I've worked abroad, I've done a bit of part-time, I've worked a bit this, bit of that, and there's no way I'm going to get 35 years. So that's it.
Okay, so there might be a way of addressing that, topping it up a little bit.
Yep, you could top up if you've got savings put aside. Then you could top up. You can top up to about £25,000. So in other words, you can make a contribution of up to about £25,000, and that will boost the state pension. You can achieve the same effect by deferring the state pension for a few years. It is also never too late to start putting money into pensions. So even the smallest amount of money that goes into your own private pension is going to help things in retirement. It's a really tax efficient way of putting money aside that you've got today for the future. But sadly, it is a problem that we're going to see a lot more of. You're just going to have to find ways of generating other income, or deferring and saving as much as you possibly can to try and boost that income for later life.
So when you say deferring, have you got a retirement age in mind, Steve?
Well, not really. I like working, so hopefully I'll work until I can't work anymore.
If somebody like Steve carried on to 70 or even older, would that mean that your pension would be worth more when you finally took it?
That's exactly it. Yeah.
Right.
So if you can carry on working, and it sounds like you want to carry on working, which is fantastic, then yes, you can defer taking that state pension, and that when you then finally draw that state pension, the pension will be significantly higher. Of course, in the meantime, if while you're continuing to work, you can put some money aside into a pension of your own, that's going to further enhance it. And whilst pensions get a lot of bad press, they are actually the most tax-effective way of saving to generate you an income later on in life. So it is a really good idea to do that.
Okay, and stay listening, Steve. We'll come back to that more general question of what do you do if you can't live on the state pension, if indeed that's the case. Steve, thank you. More calls coming in a moment. If you've got a question about retirement, about pensions, how they work, what you should do, then give us a call now. Charlie Redding is here, author of Dream Retirement. 0345 6060 973 is the number. LBC, I'm Clive Bull, and it's 8.
Clive Bull, Sunday to Thursday evenings on LBC.
I'm Clive Bull. This is LBC. I'm with you till 9. We're talking about retirement at the moment. We've been focusing on the finance so far, but obviously there's a lot more to retiring. It's a huge change in life. And I would be interested in your experience of retirement as well, or indeed your plans for it, not just financially, although Charlie here is very happy to answer your financial questions, but I think it's interesting to talk about the whole experience as well of retiring. What do you do in later life? 0345 6060 973. Charlie's book, Dream Retirement, rather implies that that you could dream of retirement, but actually, of course, it is a huge change of life. It used to be the case that people sort of died rather quickly, that they spent their whole life working, and then suddenly they stopped. They didn't know what to do, and there were these awful cases of people just kind of drifting off into nothing because they didn't know what to do with themselves. So, can you plan for the other side of retirement as well?
Absolutely. I think, when the old age pension first came into existence, it was sort of designed for people to give them about 18 months to get their house in order before they turned their toes up. And of course, retirement is a very different creature now. We expect to be going and playing golf for 20 or 30 years maybe. So it is a very different creature. And I think you can plan for that because it's a huge psychological change. You go from a very structured working life where you get a lot of the things that you need from a psychological perspective as a result of that work. Probably you've got a passion for what you do as well. So when suddenly if you retire overnight, it can be a huge challenge to get your head around what you do with your time, how you get fit and healthy. All of those sorts of things are often as much of a concern as the money side of retirement, because in a way, you can come to somebody like me and get the money side of retirement and the questions that you've got with regards to that solved probably easier than some of the other questions. And that's, in our experience, a lot of people's concern. Are
you finding as well that people are deciding to sort of not suddenly stop, but sort of phase out gradually, that they do a bit of work and they keep their hand in and they want to keep active and doing, say, part-time work?
Absolutely, we see an increasing amount of that, and I really encourage it. I think it's fantastic. I think it's a really good way of phasing in all those extra things that you want to do without suddenly turning off the tap of all the stuff that's kept you mentally stimulated. We've seen a real increase in people that have sort of decided they want to step away from the big corporate life, step out of the sort of giving every hour God sends to the big corporate world, and sort of maybe going down to maybe 3 days a week consultancy, or even packing up completely, but then following a passion of theirs like photography. Or there is a huge increase in that, and all of these pension changes actually enhance people's ability to do that, because they can draw out the money as and when they need it, but not take more than they need, so they can gradually build up to a proper retirement. And I think that's brilliant.
And coming back to the money for a minute, the previous caller was saying, not sure whether I could live on this new flat rate pension. Is it going to be realistically enough to live on?
Well,
what's the general feeling? Nobody knows, but what's the general feeling?
Well, £150 a week doesn't sound like very much to me. I suppose it's probably about the absolute bare minimum wage that you could live off. But I mean, people will do, and people will have to. But I think that if they can find opportunities to top it up, either through their own personal savings, by deferring the state pension, or by doing part-time jobs and things like that, then I think that will be increasingly common, as well as people choosing to go down to 3 days a week. And kind of I was reading about a guy in the newspaper today that is the chief economist at Lloyd's, and he's gone down to 3 days a week already so that he can do his Ironmans, because his Ironmans otherwise are eating into family time too much. So I think we'll see an increasing amount of that, and I think we've got a lot of clients that are doing exactly it.
0345 6060973. Let's go back to the phones. Fred's in Southampton. Hello, Fred.
Hello, Clive and Charlie.
Hi.
Yeah, I've got
Hi,
a different angle on this. I have a fairly limited prognosis, 15 years at best, with my health
sorry to hear that.
as it is. I'm 58 now, and my pension would start at 65, I believe. So what I'm wondering, at the moment, I'm actually applying for benefits because I'm not able to work. I'm wondering, is there any way of taking one's pension early, based on the fact that you don't have a long, you're not going to be around for the next 30 years, and taking that instead of benefits? So I would actually like to be able to take my pension now. £150 is fine, and then effectively not have to go through the continual process of the DWP and such like, all the assessments and all the rest of it. Is that a possibility?
I assume we're talking only about the state pension, or
Yes,
have you
only
got...
state pension.
Yeah, you haven't got any personal.
I've got absolutely no savings, no other pensions.
Okay. Sadly, I don't think there's any way that given the your situation, that's going to be possible. You're not going to. I don't think there's any way that you're going to be able to draw that state pension earlier than your normal retirement age. So sadly, it's going to be a case of continuing to go through the process that you are for the time being, until such time as your pension kicks in. I don't.
Seems rather rough, though, doesn't it? Really, that you can pay in, particularly if you've got a prognosis. You're paying into a system you're never going to benefit from it. I suppose that is how pensions work, though. It is a bit of a gamble, isn't it?
Well, that's it. Exactly. It's that's exactly how pensions work, and it works in that sense for the state pension, but it also works to a certain extent if you were to purchase an annuity on the private pension side as well. It is those people that live long into retirement benefit from the people that don't. So it's a sort of cross-pollinisation.
We were asking about dream retirements. Tony from Pevensey Bay says, I have a dream retirement. As related, I swapped my interest-only mortgage for a new 25-year term at the age of 66. My state pension covers all my expenses. I'm lucky to have 3 private pensions that pay for luxuries like a new BMW. I live next to the beach, top up my ego with a suntan, and it all came from working very hard for 50 years and not claiming a penny in benefits. That's from Tony in Pevensey Bay, so... Obviously, he had a plan.
Well, it sounds like he had a plan and had had the foresight to put money aside and save for his retirement, and that's really what the government is trying to incentivise people to do, and actually trying to force people to do with auto enrolment. They're trying to say, look, we can provide the absolute bare minimum, but if you haven't saved anything more yourself, I'm afraid that's all it's going to be. It's the more you save, the better you will, better off you will be, and either that can be taken as a result of retiring earlier or going into phased retirement, as we've just talked about, or it can be buying his BMW and enjoying his time on the coast.
Let's talk to John in Nottingham. Hello, John.
Hello.
Hi. What would you like to say?
Hello. About 30 years ago, I was advised by a well-known investment company to contract out of Serbs. After a short time, they told me that maybe I was a bit too young, so they advised me to contract back in. So they've held on to this little pot of money that I've got. Now I'm fast approaching retirement age. I've obviously been for a forecast from the government but they've reduced my pension each week for a weekly payment because they know I've got this little pot of money coming to me, but they've reduced it more than the actual money that the investment company are holding. So obviously I'm thinking, do I sort of go back to the government and appeal and say, well, you're taking more off me than this pot is actually earning, and can I have it increased?
Sadly, I don't think that you'll have much success going to the government and saying it hasn't increased. My own private pot hasn't increased as much as the benefit that I've missed out on. Essentially, what was happening when you were contracting out was you were being advised by that particular firm to take the money yourself and therefore give yourself the opportunity to either grow that into more money than the state was going to be providing in the future, or to give you more flexibility around how you would take that benefit. Essentially, you were taking a gamble by taking the money away from the state. Now, many people would say that often is quite a good, in the past would have said that was quite a good gamble to take, given that really all projections were that that state pensions were going to fall as with an aging population, over time. But sadly, that gamble doesn't always pay off because it does depend on what you put your money into and how it performs. I don't think you'd have any claim against the government for that. I suppose the only claim that you might have is against the company that gave you that advice in the first place. And that really is that then it comes down to what advice you were given at the time and whether that would now, whether that was clear advice and whether you understood exactly what you were doing.
Thank you very much, John. Wasn't there some sort of query at some stage about whether people were being given the right advice about contracting out?
Oh, absolutely. I mean, it's been one of those constant moving feasts over the years. There was a huge wave, and actually general consensus for a lot of people was that they should contract out, and there was bands of earnings where you'd say, the guidelines were that actually it was likely to be beneficial for them to contract out rather than staying in the earnings related pension. And then there was other changes that came later on that suddenly meant that everybody was quite fearful that actually this was now going to be the wrong thing for an awful lot of people, and life insurance companies were contracting people back in automatically unless they insisted that they want to stay out. But as you know, the pensions legislation changes are just constant, and it really is a bit of a guessing game. And I think if I was making that decision all those years ago with my own money, I would have said, I'd rather trust myself and have the money in my own pension than trust what was going to happen with the state scheme. But it doesn't always work out, does it?
Okay, Charlie Redding is here, author of Dream Retirement. That's what we're talking about. Do you have a dream retirement? Have you organised a pension? Have you got a question about that? Or indeed a point to make about retiring? 0345 6060 973 is the number. I'm Clive Bull, LBC News Time, 8th.
Clive Bull, Sunday to Thursday evenings on LBC.
I'm Clive Bull, this is LBC, and we're talking about retiring at the moment, the idea of a dream retirement, and that's the title of Charlie Redding's book, which looks at all aspects of retiring, both the health aspects, the change of life, and also the financial aspects, and Charlie is a financial advisor, so we are looking at all of those areas. If you've got a point or a question, 0345 6060 973 is the number to call. Let's go to Heather in Brockley with a point. Hello, Heather.
Oh, hello, Clive.
Hi.
Charlie. I've been saving, deferring my state pension, but I'd like to retire soon. I've deferred it for the last 5 years, but now I think I'd like to take it. But do you think, will I come unstuck regarding tax? Because I've always been in the 20%, the lower rate tax. But, I might... How can I deal with the tax situation? Is there any way I can take it bit by bit when I take the lump sum?
I don't think you can take it bit by bit. You take the lump sum, or you have the higher income. We had this with a client of ours, and sadly he had the same problem. He was being pushed into 40% tax, even though he hadn't ever paid 40% tax before, because he was getting this taxable lump sum. So it may be worth considering taking the higher income instead of the lump sum, if that fits in with your lifestyle, I suppose.
Okay. If I die before my husband, does he get my state pension? another question. If you've got time.
He should do, yeah. He should get a share of it, but it does depend on a couple of things. But yeah, he should get some of it, yes.
All right, Heather, thank you very much. 0345 6060 973 is the number. Just want to ask you this one from Ben, who rang in, but we can't get him back now. But he wants to know what your opinion is of people who are on 0 hours contracts or freelance and haven't got any pension to pay into. What is going to happen to them when they retire? What are their options?
Well, it's a great question. Yes, somebody on 0 hours contracts or somebody that's self-employed or contracting or whatever is kind of on their own, I'm afraid. It really is a question of putting the provision in place yourself. When you set up your own business, for example, or you're self-employed, you have the flexibility of kind of doing things as you wish. But one of the sacrifices you make is you don't get the benefits that you're given by a company pension scheme. So it really is about putting money in yourself. But as you want to make sure that you find an arrangement where you're not penalised for dropping in random lumps of money, because of course if your income it fluctuates, you want to be able to put money in when you're earning and not when you're waiting for your next project. So you do need to make sure that you can save with flexibility. It's often a more challenging thing to budget for. And I encourage people, if they can, to try and save monthly anyway, even if it's not quite as much as they would ordinarily want to put in any one year, and they chop it up then with an extra bit at the end, rather than leaving it all till the end of the tax year, because all too often that can get forgotten. So just trying to force yourself to do some monthly savings is a sensible option.
Now, do you come across this at all? There was certainly a time, and I think it may still be relevant now, where people just had absolutely no faith in pensions. They had bad experiences for one reason or another. And a lot of people would say to me, I'm not going to bother. I have more faith in property. If I've got any money at all, I'll pay off my mortgage or I'll try and buy somewhere. Does that argument hold water with you?
It doesn't actually, because it never did. The problem is that pensions have got a hugely bad rap, and quite justifiably so in many instances. But the thing that people mistake is that they associate the life insurance products and the bank's products that actually aren't really very good. Quite often aren't delivering what they promised. They think that is the only option, and that they think that is a pension. Well, the pension actually is the tax wrapper that the money goes into. It's a hugely tax efficient wrapper and a hugely beneficial allowance to use up. It's then what you do with it once the money's inside the pension that's important. And a lot of companies, particularly in years gone by, stuck very bad investment solutions into their pensions, and actually that's the bit that was causing the problems. And now we've got this added flexibility of taking the money out if you want to at a later stage. It just gives you the ability to pay significantly less tax, because you're usually deferring tax from your earning throughout your working life, when your tax is usually at its highest, to a point later on in life when your tax is usually at a lower rate. So you can effectively save quite significant amounts of tax by using that tax wrapper.
Let's talk to Nigel in Coulsdon on LBC. Hello, Nigel.
Hello, Clive. Thank
Hi.
you very much for taking my call.
Okay, what would you like to say?
Well, I count myself as one of the lucky ones. I've got a police pension, and I've also got a small local government pension. So it's not as though I'm hard up. But what I was wondering was, would Charlie advise me to defer my state pension? And if so, for how long? I mean, is there a time limit? And the second thing is, will I actually, because we opted out of SERPs, so will I have a reduction in my state pension?
Okay, so I'll answer the second point first, if that's okay. Yes, by opting out of the out of SERPs, you will have a lower state pension as a result of that. But of course, to offset that, you've got a personal pension that's collected this money from being opted out, that you can use in whatever way you want. You can take that money out, or you can use it to generate a higher income. So that's the first part of the question. The second part, in terms of deferring that pension, yes, you can, and yes, it's likely to boost the amount of income that you get later on, or indeed create you an extra lump sum. that can be certainly beneficial. But just be careful of the trap that other lady caller has experienced, that Heather experienced, in that if you do then want to take that lump sum, that might take you from being a 20% taxpayer into being a 40% taxpayer, or a 40 into a 45%. So you just want to be careful that taking that extra lump sum doesn't suddenly mean that you lose more of it through a tax charge that you wouldn't have ordinarily had. But it's difficult to say which you should do and at what age you should do that, because it's all dependent on your, what level of income you've got, and how much, when you're spending it, and whether you took the tax-free lump sum, and all of those sorts of things. There's a tool called a lifetime cash flow forecast that would probably help you in this sort of situation. It's something that we use to sort of map out people's life from a financial perspective, and it would just help give you a lot of clarity on what deferring pensions to a later stage would look like. But yeah, it's because it just depends on your tax situation and so many other variables.
Nigel, thank you very much for that. LBC 0345 6060 973. You mentioned company pensions earlier, and it's been quite well publicised that more and more smaller companies as well now have to provide the option of a company pension, and that does apply as well. We're talking to people. We're talking about self-employed. You wouldn't get it, but if you're, say, a freelancer employee, then you might be able to get one of those company pensions. But would you advise people to join up if your company is opting you into a company pension? I mean, you are of course opted in, but would you advise people to go along with it?
Well, yeah, I was going to say that's the first point. It's not you're not choosing whether you go in or out. You are forced to go in, and the government hopes that you then stay in. But of course, you do have the opportunity to opt out if you want. It's almost always the right thing to opt, to stay in that scheme, because effectively it's free money. It's a free pay rise. They're usually putting in 1 or 2 or even more percent of your salary. So essentially that is a 1 or 2 or 3% pay rise by being in that scheme. Yes, you do usually have to contribute some of this, and of course those contribution levels are going to be different for every different company. It's that's determined by the directors and how generous they want to be with their scheme. But absolutely, it's a sensible thing to do. You're getting government, you're getting tax back on the money that goes in. So you might find, if, for example, the government, if your company is matching your contribution, which is about the minimum they will do at this stage in the auto-enrolment process, then if you're a basic rate taxpayer, a contribution of £80 out of your pocket will mean £100 goes into the pension, but then of course another £100 comes in from your employer. So it's cost you about £80 to have a £200 lump of money that's sat there in an account that's in your name, that's growing tax-free, that's there for your future. So I would say it's absolutely a good thing to be a part of.
And what would you say to somebody in their early 20s who's just beginning to settle into a job or whatever, and really doesn't want to know anything about it? I mean, I remember people preaching to me when I just started work, saying, "Oh, you've got to, the earlier you do it." But I mean, 20s, it's very early to be thinking about what you're going to be doing when you're 67.
It is, but it's fantastic when people do, because it makes a huge difference. There's a really easy sort of... People quite often ask, how much should I put into my pension? And it's a really difficult question to answer, except there's quite a simple rule of thumb that you can use, which is very sort of back of fag packet type calculations. But it's essentially, you put in half your age as a percentage of your earnings. And you can do that for the rest of your life, and that is likely, or for the rest of your working life, that's likely to generate you around 2/3 of your final salary when you retire. So if you're 20 and you start this, then essentially you've got to put 10% of your earnings in each year, and you'll get to about 2/3 of your final salary. If you're 40, then suddenly you've got to put 20% of your salary in. It makes a huge difference. And in fact, if somebody saves from age, I can't remember exactly the figures, but it's something like, if you save from 20 to 30, I can't remember exactly the figures, but it makes a huge difference. Those first 10 years, even if you then
so
stop
they end
after
up
that,
more valuable, even if you stop. Really,
you put in a fraction. If you come to it later, you've got to save so much harder to get to that same figure.
Because I suppose the money is in with the investment for that much longer.
Well, it benefits from what's called compound growth. You get the growth on the growth on the growth. It's like the old adage, if you fold a piece of paper 50 times, then I don't know how high do you think it would get to? Have you got any idea?
I remember there's a certain number before you can't even fold it.
Well, that's it. But the height it gets to once you've folded a piece of paper 50 times is to the moon.
Wow.
And that's because you're getting the growth on the growth on the growth on the growth. So the longer you can allow that magic of compound growth to work, the more you'll have, the less hard you have to work and the less money you have to put in because the growth is working for you.
OK, Charlie Redding is here. We're talking about dream retirement. 0345 6060 973 is the number. LBC, I'm Clive Bull. 8:40.
Coming up at 9 on LBC, In Conversation with Steve Allen.
My guest this week, journalist, broadcaster and television presenter, best known for her presenting roles with the ITV breakfast programme GMTV, Fiona Phillips, and British actor, best known for Martin Ellingham in the drama series Doc Martin, and of course as Gary Strang in Men Behaving Badly. That's Martin Clunes.
In Conversation with Steve Allen. This evening from 9 on LBC.
Steve Allen will be here at 9. I'm Clive Bull, and with me is Charlie Redding, author of Dream Retirement. Lots of questions, lots of points coming in. Let's go to Tony in Mitcham. Hello, Tony.
Hello there. Very good evening to you.
Evening.
Good evening.
Paula.
What would you like to say?
I have explained to your receptionist that I'm a former regional director of sales for the British Royal Mint.
Oh.
Now I'm retired. That's now 15 years ago. What I'd like to know is, can I have a lump sum from my pension, right? Which is currently over £1,400 a month. Now then, is it possible for me to have a lump sum from that pension? I'm 76 years old.
So you've already retired, you're already drawing an income, and this is from an occupational pension scheme, is it?
Precisely.
Yeah, okay. In that case, no, not really. You're pretty much stuck with the income that they're going to give you. There are lots of options of taking lump sums out. There is also the talk of people being able to sell their annuity income in due course, but we haven't actually had all the legislation about that yet anyway. But I'm not even sure whether that will... I'm not sure that will apply to you, but sadly I don't think so. I think you're going to be stuck with the income now that you're already in receipt of your pension. OK. Sorry, Tony. Thank you for that. Ali in Manchester. Hello, Ali.
Hi there. I just had a question regarding whether is it worth saving, putting money into the pension scheme when I don't even know if I'll be working for the NHS in 40 years, or is it better to take that money out of the pension and invest in getting onto the property ladder?
Almost certainly, it's better to be in the pension scheme. The reason for that is a couple of things. The main one is that the pension that's provided by the NHS, whilst you do have to put a reasonable amount of money into it, also gets a phenomenal amount of funding. So essentially, that is a huge amount of money that they're putting in on your behalf. It's a hugely valuable pension. It's the Rolls-Royce of pension schemes, and so. So even if you're not going to be there, maybe in a few years' time, it's still worth doing. Absolutely, because that even if you leave, that money, that income that you're then promised in the future is deferred, and it will continue to grow in line with inflation. And it's a hugely valuable benefit, a benefit that you're unlikely to get matched in most private schemes. So almost certainly it's worth doing that. The other thing, of course, is that the money that's in there, all the benefit, you're getting huge tax benefits for that, whereas a property is in a taxed environment, so you're going to lose a whole lot of the benefit of the property through taxation. So I would definitely be in the NHS scheme if that was an option available to me. That shouldn't necessarily stop you wanting to do buy-to-lets, but I would definitely do the NHS scheme first.
OK, I'm going to whiz through a few quick questions now. First of all, equity release. Jace says, could you talk a bit about the pros and cons of equity release?
OK, so equity release, for those that aren't familiar with this, is the process of where you take a loan out against your property, and that loan is therefore there to give you an extra income in retirement. Equity release gets a lot of bad press, and most of it quite rightfully so. It is a very expensive option, and I think of it as being the option of last resort, really. If you're in a house that you definitely don't want to leave and you don't have enough income, then actually it is quite a useful tool. But you do need to bear in mind that interest is going to roll up and up and up, and you're going to quite easily get a very nasty shock if you want to move house or want to get out of that arrangement in the future, or the amount of money that's left for your beneficiaries on your passing is going to be drastically less. So if a downsize is possible, then I would always do that first. If you've got savings and investments, I would spend that first, and only at the point where you really have no other options would I think about starting to look at equity release.
OK, another question is about the recent falls in the stock market, how they affect pensions.
OK, well, the Great Fall of China, as it's being called, is quite a bad thing if you happen to be retiring at this moment in time. If you were to go off and buy an annuity today, then of course your fund is likely to be worth drastically less than it was in April and May. So what I would be thinking about is, particularly given the new pension flexibility, I would be thinking about deferring, crystallising that whole loss now. That shouldn't mean that you have to defer retiring. You could drip some of the money out of the pension. You could take your tax-free lump sum without taking the income. You could just drip some of that money out, bide your time, and perhaps then, if you do want to buy an annuity, buy it at a time when the market is high, rather than at this moment in time where the market seems drastically lower than it was recently.
Right, so you don't have to do it when it was set to be done.
No, you can. One of the beauties of the new pension freedom rules is that you can be a lot more savvy about how you purchase your income, or how you take an income at all. So you don't have to purchase an annuity at all. You can leave that money invested in the pension and just drip out the income as and when you need it, which is fantastic if you are doing the sort of phased retirement that we talked about earlier, because it means you can start with a low income and then gradually build up as you choose to sort of phase out of your working life more.
And Jeff says, is it as good to save into an ISA instead of a pension fund, considering all the money is tax-free?
Well, the main difference between the pension and the ISA is that the money that goes into the pension gets the tax relief now. So, as I said earlier, if you're a basic rate taxpayer, you only have to put £80 in to get £100 saved in the pension. The problem, whereas the ISA, it's coming out of taxed money. The downside of the pension is that when you come to take it out, 25% is tax-free, and then 75% is taxed at your earned income. Now, what we find, having done lots of different calculations on this, is that by saving into a pension, given the way the rules work at the moment, and given how you can take the money out of the pension and manipulate your tax at retirement, then actually the pension is better at this moment in time than the ISA. Now, the ISA is a useful tool still, because of course you can get that out before you reach 55 or 56 or 57, your minimum pension age. So it does give you flexibility. So I would always say a combination of the both is best, but actually at this moment in time, purely for retirement income, a pension is a better and more tax efficient wrapper than the ISA.
Right, well, I'm afraid we're out of time. Many thanks for all the calls and the questions. If you want to read
my guest
more...
this week, journalist,
Yes, I'm sure it is, Steve, but just wait your turn, please. If you want to read more about Dream Retirement, then it's published now, isn't it? Available on Amazon. Official publication in a few weeks' time.
It is. It isn't actually published yet. It will be by the end of this month, though. If you want to find out more, then what we've done is we've put together a free preview for any listeners that want to find out more about it, which you can find out at efficientportfolio.co.uk/book. And you can download a free preview of Dream Retirement.
Fantastic. OK, we'll tweet that out later.